He's free. He's in.
We got a whole new ball game, Matt.
"29-yard touchdown run. Ben Carlson, 21st touchdown of this, his junior season." And you
Welcome to Ask the Compound new countdown on YouTube, because I don't know, something with the production staff. YouTube was cutting off our clips.
We've had a little issue lately where, it's taking a long time to actually go live. So we just said we'll make it a minute-long countdown.
I promise I didn't ask for that.
We surprised him with that.
You ask the questions, we provide the answers. Today's show, we got questions straight from our viewers on how bonds perform in a bull market, saving for a house in a rate-cutting environment, what to do when 75% of your portfolio is tied up in your company's stock, how to benchmark performance in financial services, and how to think about alpha when it comes to using a financial advisor. Remember our email here, askthecompoundshow@gmail.com. Email us if you have a question. Today's show is brought to you by Rocket Money. The thing I love about Rocket Money is just the ease of use. They have the app. You can log in on your desktop. They send you email reminders and updates, but not too many. Here's how much you're spending this month. Here's how much your spending compares to last month. Here's your upcoming bills. Can we help you negotiate your bills? It's like a personal finance concierge. Rocket Money is a personal finance app that helps you find and cancel your unwanted subscriptions, monitors your spending, and helps lower your bills so you can grow your savings. Rocket Money has over 5 million users and has saved a total of $500 million in canceled subscriptions, saving members up to $740 a year when using all the app's features. Stop wasting money on things you don't use. Cancel your unwanted subscriptions by going to rocketmoney.com/ATC. That's rocketmoney.com/ATC. Still using it, Duncan?
Yeah,
It's helpful, right?
Yeah, all the time. Love the email notifications. Keeps you in the loop.
There we go. All right.
Before we get started today, I had a question for you. I'm on X, like usual, or Twitter, whatever you want to call it. And
I refuse to call it X. Sorry.
Yeah, it's hard, but I'm trying to adapt. But yeah, and I see there's so much kind of anti or negative sentiment about the market. So many people were calling for the ultimate crash, a week ago, basically. What's your suggestion for someone who fell into the trap, who was influenced by one of these doomsayers, and they sold out of a bunch of positions last week? What's your advice? What do they do now? What's the best route forward from there?
I guess use it as a learning experience. I don't know, because the crash can happen. They've happened in the past. They're going to happen in the future. It'll happen at some point. I guess a good lesson is figuring out your good sources of information, because the people that are saying this is a layman moment again, this is the end of the world, those are the same people that will always say that, and those are the people that will never get you back into the market, ever. So many of the people who quote-unquote called the 2008 crash have been bearish ever since and would have never got you back in. So it's a good lesson in understanding your sources of financial advice. The good thing for many young people, if they did it because it's one of the first times they've seen something like this flash crash type of thing, is hopefully you don't have as much money at stake and you can pay your tuition now to the market gods and make your mistakes early and learn your lesson. I also think it makes sense to understand your time horizon and how hard market timing is. Did you need to sell because you needed that money and you're worried about it going down more, or did you just sell because you're trying to time the market? And I thought I'd get out and then I'd get back in. And that's the difference. And I think that's the big lesson for most people, is just how hard market timing really is.
Okay. So learning experience, and get back in the market. Don't wait forever is kind of the suggestion.
Hopefully most of the time there's so many people that show their mistakes live for the world to see these days. You can learn from others, but if you have to figure it out yourself, then sometimes it's much better to do it early.
Cool. Good advice. All right. Up first today, we have a question from Jeff. Do you have an inverse chart that shows what bonds do when the market goes up, which happens more often than it falls?
Okay, so this was a follow-up to a recent blog post I wrote. So I looked at the historical performance of bonds when stocks go down. So John, give me a chart on here. This is the original post I showed. Bonds are a great hedge when stocks fall. So I looked at every positive or every negative year on the stock market going back to 1928, and I said, what did bonds do? So we're looking at S&P 500 and the 10-year Treasury here as my bond proxy. And the summary is, most of the time when stocks go down, bonds go up, but not all the time. So the average return for U.S. Treasury when stocks are down in a down year, calendar year, is up over 4%. And when stocks are down in a given year, the average is a fall of nearly 14%. So we're talking, 17% spread there or so. So high-quality bonds are a really good hedge against bad years in the stock market. So Johnny can do chart off. I've never actually looked at the other side, though. This person, Jeff, asked the follow-up. So how do bonds perform when stocks actually go up? And I think a lot of people mistakenly assume that when stocks go up, bonds don't do much, they go down. And when stocks go down, bonds go up. And there's this inverse correlation, but it doesn't really work like that. So John, let's do our next chart here. This is every positive year in the stock market. You can see there's obviously a lot more positive years in the stock market than negative, and bonds have held up just fine. You can see there's a handful of negative years, but the average returns for bonds when stocks go up is pretty good. So the average return when stocks go up is actually higher than the average return when stocks go down for bonds. So the average is 5% when stocks go up and 4.3% when they go down. John, throw our next chart up here. This is the money chart right here. So I broke them out between the average year when stocks go up and the average year when stocks go down. You can see there's a much wider range for stocks. So when stocks are down, again, the average is 13 or 14% down. When they're up, it's up 21% on average. That's a pretty wide range. And bonds are up 5% when stocks are up, 4% when they're down. Bonds are obviously far more stable than the stock market. Johnny can do chart off. But the distribution of bond gains and losses is actually pretty similar too. So when the S&P 500 was positive, bonds were positive 80% of the time. When the S&P 500 was negative in a down year, bonds were positive 80% of the time. So it's kind of similar. There's really no discernible difference. That you do get this flight to safety in a financial crisis, but again, those things don't happen very often. So what does this tell us? Bonds are a pretty good diversifier. There are, of course, environments where bonds can be harmful and they're not the perfect hedge. 2022 is a perfect example. Stocks fell double digits. 10-year treasuries fell double digits. The whole point here is diversification works most of the time, not all the time.
That broke a lot of people's trust in bonds.
Yeah, I think it did. And that's why I'm trying to provide the reminder here that, yes, when rates go up and inflation is going up, bonds are not going to be the best hedge in the world. That can be, if bonds are the reason stocks fall, that's not going to be a great diversifier. John, throw that other chart back up, which shows the last chart with the average gains and losses. So that spread between stocks and bonds, and the average return on an up year is 21%, average return on a down year is 13%, negative 13%. This tells you all you need to know about the risk, like why there's a risk premium in stocks, because there are a lot more bad times in stocks than there are in bonds, right? So the stock market earned more than double the annual return over bonds for the past 96 years, partly because the gains are bigger because the losses are bigger, right? You can't earn that risk premium without taking some risk. But I think the good news for diversified investors is there's a time and place for both stocks and bonds in a portfolio. Stocks and bonds both finish the year with a gain simultaneously, right? Same year, 60% of the time. And bonds were higher than stocks in almost 40% of all years, which is probably surprising to some people, that the stock market doesn't always outperform. So 4 out of every 10 years, the bond market has done better than the stock market. So stock market, better for the long run, not always the short run. Bonds are up most of the time, whether stocks are up or down. Not the perfect hedge, but fixed income is still one of the simplest stock market hedges there is. And I will stick with that even after a bad bond bear market that we just lived through.
A good time to go watch or read Bob the Market Timer, too. Or Bob the World's Worst Market Timer, right?
This is
the blog
true.
post Ben did, and a video we did.
Yes. I'll by far my most popular blog post every year since 2014. I peaked early. Just like my high school football highlight, I peaked way too early. Story of my life.
Now it's paying dividends, you know?
All right. Next question.
All right. Up next, we have a question from Sam. Hey guys, longtime listener. I'm a Marine warrant officer about to do 3 years overseas. 5th time in Asia. Can't complain. I used a high yield savings account to slowly amass $130,000 cash for a house, which I now won't be buying this year. I have a brokerage with $220,000 and IRAs plus the thrift savings plan with around $120,000. With an incoming bonus and 3 years of pure savings, essentially, how much of that high yield savings account plus bonus should I put to work in a brokerage as opposed to just making future contributions? Is 3 years too long to let $130,000 in cash ride with falling rates?
Isn't it funny how many of our viewers use the HYSA for the high yield savings account? That's just a thing now.
It's a lot to spell out,
So I love seeing all the questions we've been getting from active service members and veterans in the past few months.
We have a lot of people watching from the military. It is kind of cool.
Yeah, it's also cool to see so many of them doing so well with their finances. And Bill Sweet has told us about this. One of the reasons Bill got into finance, hope I'm not stealing his thunder here by telling a story, is that he was in a leadership position in the Army, and all of the cadets that he was working with were saying, hey, I'm making money for the first time. I need help. And that's how Bill kind of got in and learned about finance. So it's cool to see so many of them doing so well with their finances. So this is one of those problems that's good to have, but it's a dilemma nonetheless. Like, I have too much cash. I don't know if this was a surprise that he's getting sent overseas again. What do you say? His 5th time going to Asia, which is crazy. So I guess there's a few considerations here. So if you're really putting off the purchase of the house, my first question would be, is there anything else that you want to purchase, that you want or need to buy right now that you can get ahead of? Because you have this big cash slug and you're going to be saving for 3 years. I'm guessing the reason he's going to be able to save so much is because the Marines take care of most of the cost of living, and he'll get some stipends, and so saving will be much easier. The thing is, the money doesn't necessarily have to be invested if you have other needs for this cash. That's my whole point. I guess if you are considering to still buy a house in 3 years when your tour overseas in Asia is done, I guess I would think long and hard about your appetite for risk. So John, throw up our next chart here. I just did a little rolling 3-year returns for the S&P 500. Pretty good the last 3 years. We're talking 32% return. But I see the green there is positive for rolling 3-year returns. Like, it went back to 1926 here. The red is negative. So the good news is stocks are positive most of the time over 3-year windows. We're talking 85% of the time going back to 1926. The problem is, how bad would you feel if you took part in those 15% of negative results? At its worst point, the stock market was down nearly 40% over the previous 3 years as of February 2009. That's the last time this happened, pretty much. I use monthly returns for this analysis, so I'm not going down to the day here. John, you can do a chart off. Obviously, there's plenty of wiggle room in between high-yield savings account on one end and stock market on the other end. You could dip your toe into the stock market if you want to take some risk, but it sounds to me like you're going to be able to save a lot of money in the next 3 years. So assuming your costs are minimal when you're deployed, the good news is if there are any losses, you have the ability to make it up with future savings. So Sam is in a pretty good position here. We talked last week about holding cash in a declining rate environment, which is the big worry for a lot of people in this situation. When it comes to liquidity versus yields and risk, I almost always err on the side of liquidity personally. So a few years ago, I was in the same situation. I was saving money for a down payment for the new lake house we were building, and high yield savings accounts of that, HYSA, is that right? Those yields were essentially zero at the time. But I still kept it in there because I cared more about the liquidity and I didn't want to lose any money. I wanted to make sure that money was there and I wanted to have the exact amount in there. And I kept it parked there just because I wasn't comfortable taking risk. Personal preference, obviously, as always. The good news is Sam is in a great place financially. The cash he has gives him a lot of optionality. And you also have to remember that rates aren't necessarily going back from 5% to 0% immediately. And maybe never going to 0% again, right? Even if rates bottom out at 3 or 4%, it's going to take some time for the Fed to get there, barring a huge catastrophe in the economy. So my biggest advice here would be, like, don't be into a rush to get into a decision right before you leave or something, right? You can take your time. There's no shot clock here for financial decisions. So I would just don't be in a hurry to make a decision either way.
So if you had to put this money into one stock for 3 years, I'm just kidding.
I think we know your choice.
No, it would not be. It would not be.
You're not going to double and triple down?
I've done that too much already, so yeah.
Okay. The more dry powder for Duncan. All right.
Yeah.
Next question.
Okay, up next we have a question that came in from Twitter. Amazon employee of 6 years and haven't sold a share. I don't need the money per se, but it's a lot of my portfolio given the RSUs are about 75% of my net worth. Do you think it's fine, or am I better off selling at $200 and going ETFs at this point? I held a few years back from $175 down to $85. So I have the stomach for it, but it gets frustrating. It's a pretty sizable drop there.
Yeah, keep going.
Everyone I work with is getting tired of this, especially since our 2024 RSUs were granted at $190 a share.
So I think maybe where the frustration is coming from is the fact that over the past 3 years, I just mentioned, the S&P is up 30-some% over the last 3 years. Amazon is up 3%. So Amazon's kind of gone nowhere for the past 3 years. Now you have that big dip in 2022 as part of it. So that makes sense. But we see a lot of clients who come to us with heavy concentration like this, right? This person has 75% of their portfolio in Amazon. We get this a lot with clients, so let's bring in a financial advisor who can help out here. Alex Palumbo, who's worked with a lot of clients who have similar situations. It seems, Alex, like it's a lot of tech employees who have this, which is a good problem to have, again. But these conversations can be tricky because I feel like these people feel like they know the company and the stock better than anyone. And so they feel like they can time it better. But they know it's prudent to diversify, so there's like this psychological tug of war. So how do you approach these conversations when someone comes to you with a huge chunk of their net worth in a single stock?
Sure. Well, thank you for having me, Ben. Duncan, great to see you again.
What's up,
So it does tend to be tech employees with over-concentrated positions in their employer stock. They do know more about the company, generally speaking, than we do. But when you talk about a company that has hundreds of thousands of employees like Amazon, like does like the level 3 manager making 200K really know about the interworkings of like some of the larger scale decisions within Amazon? I mean, I don't think you'll get any sympathy from this panel who has put all their money into Oatly stock in terms of the drawdowns that they've had to stomach.
Amazon was down 95% in 1999, just like Oatly. So
It's true.
They're on the same wavelength if you go back far enough. But yeah, to your point, it's easy to get overconfident in these decisions because you feel like I'm in the company, regardless of if you're the CEO or a high-level manager. So how do you approach these conversations and have this situation where people don't want to sell too early, but they know they have to diversify? So how do you help them through these decisions?
I have an absolute bestie, shout out Danny, who is in this exact situation. I'm not sure if he's ever made base salary that much money, but he started at Amazon 10 years ago, probably making 15K in RSUs, but they've ballooned to 100K worth of RSUs, vesting every year, etc. And I work with a lot of people in this exact situation. They have to seek the advice themselves. They're never going to diversify proactively, especially once they've tasted that sweet plus 90% upside in 3 years. They start to diversify during periods of underperformance, and then maybe eventually they'll learn their lesson to just come up with a plan that they're going to be acceptable, that they're going to deem acceptable through all market environments, right?
I agree with you that people don't come looking for diversification advice when their stock is up a bunch. It's usually after they've had a little bit of a rough patch and they go, okay, now that I've seen this, I know I need to diversify. So is it the opposite of dollar cost averaging?
Yeah, 75% in Amazon. Okay, sell 1% a month for the next 4 years. Now you have 50% less. Now you have 25% of your net worth in Amazon. Are you going to be okay with that if the stock is up 50% by the end of the year? Are you going to be okay with that if the stock is down 50% this year? And you have to play that mental exercise with yourself. And once you establish a plan, do not change your plan.
That's the point, yes. Is because the perfect plan is only going to be known after the fact. So your point is correct that come hell or high water, whatever we choose, you stick with it. Now, how do you handle the tax side of things on this? Because that's a worry for a lot of people too. Is well, if my net worth is up because I've got huge gains here, but maybe I don't want to sell because I'm paying taxes then.
The tax side is super interesting. A great way to pay no taxes is to not have any gains, to quote a great Bill Sweet. Yep. So if you don't want to sell because you're in the 20% capital gains bracket, plus net investment income tax, plus some state tax, you can be recognizing $100,000 of capital gains and you're paying $30K in taxes, which is tough to stomach. What we do for clients is instead of selling 1% a month, let's say for a 12% of your exposure, sell 12% in January. You recognize those gains up front in January, and then you use that dry powder that's now in cash, not in Amazon stock, to buy a diversified basket of other holdings. And throughout the remaining 11 months of the year, you can tax loss harvest and try to reduce the net capital gains that you have for the year. Right. We do that for clients a lot. I'm working with a client right now who has a very over-concentrated position. January 1st, we're selling a third of his exposure in 2025, 2026, 2027, leaving him with zero. But you don't want to be selling this stuff in December if you've been over-concentrated for years, because then you're guaranteed to pay taxes, where you can just extend the time frame that you're able to tax loss harvest if you do it in January or February.
And I think that makes a lot of sense to me, because I think the problem is, and I think this question kind of alludes to it, is just don't try to get too cute with these things and try to I'm going to time it perfectly and get out, because that's never going to happen where you time it perfectly and you think because you know the company better that you're going to get out at the most opportune time, especially if you're frustrated with the company for whatever. Slowly but surely diversify, be tax aware, talk to an advisor potentially. That makes a lot of sense to me.
You show these charts all the time. In 30 years, there's almost a 0% chance Amazon will outperform the S&P. But there's also a 0% chance that the S&P itself offers the upside that Amazon, the individual stock, does. And
Right.
you have to make the decisions according to that information.
Regret minimization, definitely. Next question.
Okay, up next we have a question from Michael. I'm in healthcare. Aside from patient satisfaction surveys, there's no specific objective rating on a provider's performance in their profession. We undergo peer review for licensing purposes, but we can't pull performance data from anywhere that tells us how well we're doing. Troubling, right? As a CFA or CFP, I suspect you are better at tracking this for yourself, but I might be assuming that. How does a CFA or CFP know if they're any good at their job? Does it come down to client account performance versus the market? Is it more about client satisfaction and achieving their financial goals? All of the above, none of the above? How does someone in the financial services industry demonstrate performance overall and compared to their peers?
This is a really good question, because it's, especially in a service-based business. Now you can say, listen, the performance is the way that you measure this, but I would argue that it's the big mistakes that would, performance-wise, that would allow you to judge as an investor, because the market is going to do what the market does. No advisor, no investment professional can control the market.
Well, in performance, you're always looking backwards, right? I mean, so that's part of the issue there, right?
Yeah, and there is a scorecard in some ways. And I guess it depends how you invest. But Alex, for you with clients, how do you judge a successful client? Because my way of thinking about it is the client on track to achieve their goals? Yes or no? That's end of story. That's the biggest thing. Is that the same way you look at it?
Well, part of me wants to think that you saved this question for me as the in-house resident YouTube MD, the YouTube doctor here, just making sure that we all benefit from proper cardiovascular health, reducing the myth spread by big statin propaganda. In fact, I think you'll see a direct correlation between the touch of gray, Ben, that we're seeing in your hair and you becoming a vegan. So that is an interesting, and now correlation doesn't really mean causation, but
John,
we see
hit the
Duncan's beard
disclaimer
also,
that no one on this podcast is qualified to give medical or diet advice.
So why this is such a fantastic question is because conflict of interests, whether you would like to admit it or not, specifically Ben Carlson, are rampant in healthcare, right? Their metrics are profitability. How many procedures does a surgeon do? How many pharmaceuticals do you provide? How many patients do you see? So patients' health is actually directly non-correlated to profitability. If a patient has to come see you 10 times to fix their issue versus one time, you might be paid 10 times as much.
Well, the point is that there are conflict of interest everywhere. So the question for financial services is, okay, how do we actually figure out the way to judge them? And my point is, your clients, are they reaching their goals? I think a great way to judge this is, are you getting referrals from your current clients? Is your turnover low? Are your clients happy? They're not leaving? And so I think if your clients understand what's going on with their money, that sort of thing, and these are sort of squishy, qualitative ways to view success, but I think that's the way you look at it. And when you have your conversations with your clients, happy or unhappy, what's the stuff that they're looking for in terms of goalposts going through the relationship?
Yeah. So it's very interesting that this person who works in the healthcare space recognizes this, and it's a really great question. Here's why it's different in our space. At least our firm gets paid based on an assets under management basis. So we bill our clients a percentage of the assets that we manage. If their accounts are up 10%, our fee goes up 10%. So there's a direct correlation between how much money our clients make and how much money we make. If their performance is terrible for 3 years straight and they're losing money, so are we. So that's where there's not the same conflict of interest as in the healthcare space. Talking about specific benchmarks, there's two ways to look at it. One is what you said, Ben, your client-specific financial plan. What is the percent rate of return that we are projecting within your financial planning analysis that says, hey, listen, if you get a 6.5% rate of return, there's a 95% chance you can achieve your goals. And trying to benchmark that every year, the problem, as you know, Ben, is no portfolio is really ever going to get you 6.5% per year on an individual year, even though if the average
year
is
in
still
and year
gonna be
out, you're not going to get
6.5%.
the spreadsheet answer that you want.
Exactly. So I think the real answer, if you want a more quantitative and measurable answer than the qualitative stuff, which you're right that you mentioned, is comparing apples to apples. Our portfolio, let's just say, is 40% U.S. large cap. Compare that performance to the S&P 500. Our portfolio is 15% small cap. Compare our portfolio's small cap exposure to the small cap benchmark. There's no point of comparing a diversified portfolio of 10 asset classes to the performance of the S&P 500, for example. And that's how you can make a good benchmark comparison on an apples-to-apples basis.
Yeah, the good thing is there are ways to
portfolio.
quantify this, but it's also understanding, like, benchmarking correctly. Are you looking at the same things? Not just, is my diversified portfolio beating the S&P 500? Because sometimes that is a problem too, is people use the wrong benchmark. So yeah, you have to do an apples-to-apples comparison.
I have some more things, and I was going to say this on the next question, but it's kind of maybe more relevant to this question. Also, kind of to your point, what is your benchmark? Is it having as much money as possible? And if that is your benchmark, are you willing to succumb your portfolio to as much volatility as possible? And lastly, what is your happiness benchmark, Ben? What is your happiness benchmark? Meaning, let's say you work with a financial advisor who promises you this outperformance, and 5 years later, you have 5% more money than if you put it in the S&P 500. But you looked at your portfolio, 50% more, and we're 60% more worried. Do you really give a
your
crap?
sleep at night quota, right? Like how?
Yeah.
Yes, I agree.
And that's very important.
It's also true that that means different clients are going to have different benchmarks, and they could
Exactly.
be thinking about things in different ways. So maybe the biggest part is knowing your client, understanding what's going to make them tick or anxious or that sort of thing.
Is there a scenario where you would be nervous as a client if you saw your portfolio up a certain amount in a year, where you'd be like, wait, how are we getting that? Is there too much risk?
I don't think anyone's ever complained about having too many gains, Duncan.
Well, but I'm just saying, if you see that you're up a ton in a year overall,
my biggest weakness is I care too much.
Yeah.
No, but that's a good red flag. You're right. It's if you're not within the realm, the expectations of what markets are doing. If the markets are up 20% in a year and you're up 50%, yeah, you have to be asking your advisor, that's great, but how much more risk did you take to get there, and what's the other side of that potentially?
Yeah, what happens when the market's down 12%?
Yeah.
If your advisor cannot clearly articulate why your portfolio has the performance it can in a way that's layman enough for you to then regurgitate that to someone else, you're probably not working with a good financial advisor.
Yeah, that's a big part of it, is understanding what's going on with your money and why. Let's get to the next one, because it's kind of similar to this in a different way.
Yeah, I like this one too. Okay, Dave writes, I'm speaking to prospective advisors, and one guy keeps talking about alpha all the time. Apparently, his firm touts outperformance as the main selling point. Outperforming the index sounds great and all, but I'm dubious. Ben's always talking about how hard it is to beat the market. Is this a huge red flag?
Dubious. Good word. I like it.
I like that.
Some similarities to the last question, but I think this one is important. So to your point, Alex, like, what kind of excess risks are you taking to get that excess return? And the other thing is, financial advisors provide so much more than just portfolio management. So Vanguard has their quantifying advisor alpha report. So John, throw up this little chart here, and they look at it outside of investment performance. So, but they look at asset allocation and using cost-effective implementation. So looking at fees, keeping fees low. They're saying rebalancing can add value, asset locations, spending strategies. How do you withdraw your money? But the biggest one they have is behavioral coaching. They put kind of a range on these things. And the biggest one they have is behavioral coaching, anywhere from 0 to 200 basis points a year. And Vanguard is pretty quick to say, like, listen, these are not like set in stone. These are not exactly what you're going to get, but these are things that can get if you keep your client on course. And the whole point is, I think, that if you have these smaller edges from a financial planning perspective, you keep people invested to stay the course, you keep fees low, you rebalance the portfolio, you're tax aware about your asset location, what kind of accounts these certain assets are in. That's a way better way to add value than trying to outperform the market, which is a fleeting thing and does not last, and it's very hard to do over the long term. Alex, I'm sure you've dealt with clients who come to you and say, I want Ritholtz to pick stocks for me, right? I want you guys to pick the best investments. I want to outperform. How do you handle those kinds of situations? Because there's obviously people who think that's the be-all, end-all here, is just how am I doing against the S&P or whatever benchmark there is.
He sends them to me.
was a good one, Duncan. I think in addition to all of the data you showed from the Vanguard study is understanding, and Duncan's point in the very beginning of the show, after that insanely awesome highlight of you running for that tutty, unbelievable. That was the best intro of all time. Is when Duncan's like, yeah, my friend who it's my friend. I'm asking for my friend. My friend may or may not have gotten out of the market because of the end carry trade. I think that happens a lot. Like, obviously we know people that overtrade, qualitatively overconcentrate, or pick stocks. Like, they're going to outperform and underperform on a year-to-year basis. And let's face it, they're going to eventually come to an advisor. Even like some bogleheads who follow the market a little bit too much or an appropriate amount, all it takes is one decision to platoon literally decades of proper investing. And if you're working with a good advisor, that will simply never happen. We had someone email us and reach out. They were a buy and hold Vanguard guy for 30 years. And then they tried to tax loss harvest in late 2022. The Qs, do you remember this email? They tried to tax loss harvest about $500,000 in late 2022 and then just didn't get back in 2023. That was a 50% mistake on $500,000. And you compare that to paying an advisor a few thousand bucks a year for
really matters.
20 years. So that's like all it takes is one or two bad decisions to like platoon years of good investing. What was the question? If all this advisor's touting is outperformance? I mean,
Just
yeah,
in
if you're
general,
listening to...
If you hear a lot of talk about alpha, I mean, is that a red flag, would you say?
Yeah, I mean, if someone, all they're talking about is alpha, like obviously that's the biggest red flag. If you're listening to Ask the Compound, Ben Carlson's YouTube channel, you already know the answer to that. So like no matter what this guy tells you, if you're going to invest with someone based on alpha, you will be not happy at some point. Is it going to be in 6 months? If you underperform 6 months from now, what happened? If you outperform for 1 year and then underperform for 6 months after that, then what are you going to do? And then getting back to our last question, like the volatility reduction. To Duncan's point, because you get this point from me, no one cares about reducing volatility when you look at your past performance. You don't care how you got there. You just want the best possible performance. But everyone cares moving forward. So you got to say like, all right, you're going to outperform. Well, am I going to have to succumb myself to 70-80% drawdowns for how long? 3 months, 3 years, etc.
Yeah, and the point is a true financial advisor provides way more than portfolio manager. There are some managers out there, of course, that investment managers who their only job is to outperform the market. But that's the difference between a portfolio manager and a financial advisor who are not doing nearly the same job. There's so much more that goes into being a financial advisor than just investment management. Investment management is a big piece of it, obviously, and we take that part seriously. But there's so much more that goes into it beyond just the portfolio.
Also, for the record, last week I was buying 3-time levered funds. Just for the record.
Perfect.
Duncan, that doesn't make me feel any better. What are you still buying leveraged funds for? Do you not listen to this show?
I didn't sell all my stocks. That's my point.
Okay.
The best is looking at a long-term graph of the 3 times levered charts, and they're all down 99.9%. And Duncan's like, I'm going to buy and hold that for sure.
No, not of the Q or S&P.
Yeah, some of them actually do okay. But Duncan, talk to me after class.
The last thing I'll say is maybe this person talking to a prospective advisor, he was talking about behavioral alpha.
Yeah,
you never know.
It's possible. I hope so. So anyway, check out if you haven't checked that out. That quantifying advisor alpha is worth checking out from Vanguard. Thanks to Alex for teaching us all about how the healthcare industry works today. We're all dumber for learning that.
You're welcome. Eat your eggs. Eat your eggs. Eat your protein.
Not nutrition advice.
Send us an email.
And you'll be as jacked as Ben in college.
All right. That was high school. By the way, state championship game. Just so you know, that I performed under pressure. Our email here, askthecompoundshow@gmail.com. Send us your questions. We appreciate it. Next week, we're going to be on a day earlier because we have a conflict. I'm going to New York. We'll see you then.
See you, everyone.